Hey guys, happy Monday. I hope everyone had a great weekend. I went and did some crazy rivers and had an awesome time. I just wanted to hop on real quick and talk about two things. Those are non-forfeiture options and guaranteed universal life. First is non-forfeiture options. So, permanent insurance that builds cash value, so universal life, whole life, all of that have non-forfeiture options. That's what happens if the client stops paying on the policy. They have a default. That's what happens if they don't let them know what they'd like to happen, or sometimes there's options. For example, if you're writing a forester's whole life, if we've written through one together about making sure that the APL is checked. APL means automatic premium loan. They'll pull a quarterly payment from your cash value so that your policy doesn't lapse and it remains in effect until the cash value runs out. It's in the form of a loan. You got to pay it back to put your cash value back. But it keeps the policy as it is and is the best option. Now, there's two other options that it just really depends on the product, which one it defaults to if you don't pick APL. First is ETI. This is extended term insurance. So they take the cash value in the policy and buy a term policy. So let's say there's, I don't know, $4,000 in cash value in something and they're 40 years old. They're like, well, that would buy them a $50,000 term policy for 23 years or whatever it is. Usually if the policy's built up for a little bit, it's quite a lot of time. Like the Gerber baby policy, if you stop paying on that when the kid was like 18 and bought it when they were a baby, they would have a 30-year like face amount term policy. So if the parent had bought 25,000, they'd have 25,000 in term insurance. I saw ETI pay out all the time there because that is the default non-forfeiture option. You had to let them know for an APL. The other option is RPU, which is reduced paid up. So that just means they take the cash value of the policy and determine how much permanent insurance it would buy. And it's not very much. Guaranteed life for older folks is one you saw this happen a lot. That's usually the default for that one, not APL. And it would be like, well, they had $400 in cash value, so that bought them $800 in permanent insurance. So it was something, it was there, the policy just didn't dissipate. People would sometimes get upset when they called in and realized they had a policy and the cash value been, being taken away for that. So those are the non-forfeiture options. APL is the best possible because it leaves the policy as is, but it does take cash value in the form of a loan. And then the other thing I want to talk about was a guaranteed universal life. So guaranteed universal life is kind of like a whole life policy in the beginning and then a term life policy at the end is the best way to explain it, but it lasts forever. So it builds cash value, it's permanent and forever, but you stop paying for it at a certain point if you stage it that way, and the cash value pays for the insurance. The guaranteed at the beginning means the company promises what the illustration says happens will happen. For example, I ran one for a 35-year-old female. She was just average height and weight, 5'5", 140, I think. And monthly premium is $80.26, and the death benefit is $100,000. This is through North American. Everybody that's contracted with me should have North American already. If you don't, let me know. The things I like about North American, they have great living benefits. Life insurance is also for being alive and sick. So they have the chronic, the critical, and the accelerated death. So, hey, I have Crohn's disease, hey, I had a heart attack, and hey, I'm going to die are all covered. And then it also does build cash value. So if they get further down the road and decide they do want to cash it in, though it didn't build a ton of cash value like an indexed universal life will, it did build some. For example, this client's peaks at age 55 and age 60 and has $20,000 of cash value. So we were discussing how she may want to cash it in someday or may not. And I said, well, you would just cash it in on these years, 55 and 60. And have the best cash value. After that, it slowly trickles away, and after 70, the cash value is nothing. It's zero, but it lasts until age 100. The accelerated benefits are great. All of that stuff is good. Um, it's just an overall good policy for people that are a little risk adverse but want permanent insurance that's a little more affordable. $100,000 for $89 a month is pretty good. If you would like to talk through illustrating a guaranteed universal life, just let me know. I'm here for you. I hope you guys have an awesome Monday. Talk to you later.